A 4-for-1 stock split in the middle of a trade war. With building fears of inflation and a recession, Loblaw isn't just playing defense. They're setting up for their most profitable run in years. Could this split be, could it be the smartest move of 2025? Hold on to your seatbelts, folks, to this. This is going to be a good one. Loblaw just posted strong earnings, announced an aggressive stock split, and they are positioned to weather tariffs in a potential recession better than almost any other Canadian company. Today, we're breaking down the numbers, the strategy, and why this move could pay off big time for investors. When the economy slows, consumers tighten their belts, but they don't stop buying the essentials. Groceries, household products, and medications, they all remain in every budget, even as spending on some of the more luxurious items dries up. That's why the consumer staple sector has a reputation for being recession-proof. This plays directly into Loblaw's strengths. Not only do they dominate Canadian grocery retail with banners like No Frills, Real Canadian Superstore, and Maxi, but they also control the strong private label brands like No Name and President's Choice, which capture cost-conscious shoppers while protecting margins. Loblaws will be doing a 4-for-1 stock split on August 18th, and that means shareholders can look forward to receiving 3 additional shares for every share they bought before the market close on August 14th. And this does not change their overall market value, but it sure does lower the price per share, and that makes them an easier choice for many investors. The split may stoke more interest in their shares, and that can add to market value, as the added demand also increases liquidity and overall improves trading activity. By pairing this stock split with a solid earnings beat, Loblaw, they're signaling confidence in their long-term growth, sending a clear message. They expect demand for their essential products to stay strong no matter what the economy throws at them. This does bode very well for the overall strength of their position in the market. A sub to the channel improves your position to enjoy future content. They just recently released their Q2 earnings for 2025, and they were not too shabby to say the least. They exceeded both in earnings and revenue, which, it certainly gave their stock a little pump. I do like to feature a few of the highlights from that report to give us a more thorough overview of the company. For Loblaw, it's all about earnings and revenue for sure. Revenue came in at $14.67 billion, up 5.2% year over year, driven by strong demand for discount food and pharmacy essentials at banners like No Frills and Maxi. The adjusted earnings per share, that did come in at $2.40. That beat expectations. They were anticipated to come in at $2.33. Same-store sales, those rose 3.5% in food retail and 4.1% in drug retail. E-commerce was one of their standout growth channels. It was up 17.5% year over year. Oh boy, that's not too shabby. I do love what I've seen so far, but even with all of that, we're going to have to take a look at their fundamentals. Of course, if there are numbers involved, we need to call on the Sergeant of Splits, the Earl of Earnings, the one and only Mr. Math. We will start off with, as usual, a little bit of their surface data. So at the time of recording, their current value was coming in at $227.10. Mind you, after the split, that'll work out to $56.78. Their market cap sitting at $67.38 billion, and their beta coming in at 0.38. You can see the overall stability in a consumer staple stock right there in that value for sure. Oh boy. Their earnings per share coming in at 8.07, and they have a price to earnings ratio of 28.09. Now the average amongst their peers is 22.2. Speaking of those peers, we have Empire. Their PE ratio is sitting at 18.0, Metro 23.1, and George Weston, they're tops, 28.8. Looking at their price to book ratio, that's coming in at 6.02, and their return on equity 20.60%. I like that a lot. You know me, if it's above 20, I'm happy. Return on assets, they're coming in at 6.40%. The surface data, it does look good, and I really don't have any concerns at all. Let's peel back another layer and take a look at their cash situation. So their revenue currently coming in at $61.57 billion per year. The earnings on that, $2.20 billion. Now those earnings are projected to grow by 3.76% per year over the next 5 years. Their profit margin sitting at 3.59%, and we've got a free cash flow of $3.84 billion, operating cash flow coming in at $5.90 billion. It goes without saying that they have a pretty healthy cash flow. I do like to see that. Okay, let's take a look at that fair value. So once again, their current value, $227.10. Their fair value, as per a discounted cash flow model, coming in at $168.02. That does paint them as being overvalued by 34.9%. Oh boy. Now, the analysts have a 1-year target for Loblaw of $235.09. Although when we get there, we'll have already had that split. So it'll actually be $58.77. Nonetheless, that is an increase of 5.16%. So, analysts are still seeing growth, and with the stock split, I really think they may be valued closer to fair than that fair value data may suggest. Okay, let's dive a little deeper and take a look at the return data. Okay, we'll start with their dividend. They have a yield of 0.25%. It is a quarterly dividend of 14.1 cents per share. Now, it was 56.4 cents per share, but with that stock split, the dividend also splits to match. So that's why it's a quarter of what it used to be. Their payout ratio, that's coming in at 26.06%, so it is very sustainable. Their 5-year average dividend growth increase is coming in at, 15.81%. That's not too shabby. Now, I will point out, they are a dividend aristocrat, as they have raised their dividend for 28 consecutive years. So that's a pretty good track record for sure. Okay, let's look at that share value. So their 3-year return on investment, that's coming in at 93.21%. Factor in those dividends, we get a total return of 97.99%. On their 1 year, that return on investment, 38.78%, adding in the dividends, total return 40.02%. That's a really good number. Their 3-year annualized, that works out to 25.57%. These are solid total returns for sure. Of course, the final layer may be the most revealing as we take one last dive into their debt data. So their current debt, it's big. They got a lot of debt. $9.20 billion. Holy banana bread, that is pretty big, but it's all relative. Their total equity, that is coming in at $11.11 billion. So that means their debt to equity ratio is only 82.8%. Now, I do need to point out, in the last 5 years, they have taken on more debt, as that debt to equity ratio has grown from, 5 years ago it was 71.2%. Of course, I would very much like to see them moving in the opposite direction. We will look at cash and cash equivalents. That is coming in at $1.94 billion. Looking at their short term, they have assets of $13.94 billion and their liabilities coming in at $10.52 billion. That's great. I like that. Long term, assets of $26.06 billion and liabilities of $18.37 billion. Once again, that's not too bad. I do like that as well. They do have a lot of debt, but they also have the equity to back it up. Their debt is indeed covered by their operating cash flow, and the interest on that debt is also, while it is well covered by their EBIT, those earnings before interest and taxes. When it comes to share dilution, that is not even a factor. We're looking at 0%. I do believe we have enough data now for us to come up with a final verdict. Does the stock split change the game when it comes to Loblaw? I kind of think it does. They are a very solid blue chip stock with the fundamentals and business models to survive and, even thrive in a recession. The only problem is the price being a little high when folks are more budget conscious. This stock split solves that problem and could very well increase their overall popularity with the more frugal investor folks. It is said that timing is everything, and this time the timing was more than spot on for sure. This is a great stock for the typical dividend growth investor, as the total returns should continue to grow and perhaps stay mostly in the green as other stocks may stumble in more challenging economic eddies. The income investor may not find much here to interest them, and that does make sense, as this is a growth play. However, if you are looking for a solid blue chip for one of your less income-focused accounts, Loblaw has your back. If you are interested in Loblaw, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on infrastructure stocks. Thank you for watching, and I will see you in the next video.